Every alarm the market knows how to ring, ringing it once. That has happened exactly once in 100 years, and you're looking at it. This is the crash that took 89 cents of every dollar and didn't give them back for 25 years. And the strangest part? The board saw it coming. This is Sovereign History, where we read the market's biggest moments through its instruments, not its headlines. And this is the story every gauge we run was built to catch. On the 3rd of September 1929, the Dow Jones Industrial Average closed at 381. It would not close there again until 1954. A man who bought the index at that peak and held on waited 25 years to break even. The people buying weren't fools. They were buying electricity, radio, the automobile, the future. And the future arrived exactly as promised. And the market still lost $9 of every 10. To understand the top, look at the money underneath it. By 1928, lending cash to stock buyers paid 8 to 12%, so much that ordinary companies began lending their treasuries to speculators instead of building factories. Investment trusts, the era's version of a fund that buys other funds, floated 265 new vehicles in 1929 alone, many borrowing to buy each other. Radio Corporation of America, the decade's darling, traded at 73 times its earnings. Here is the climb itself. From the middle of 1927 to that September peak, the Dow rose 90%, and the pace kept rising the whole way up. On our board, that is gauge 7, acceleration, a 12-month surge so far beyond its own history that the trend has become a vertical line. And vertical lines do not flatten gently. Now for the part almost every retelling skips. Run the same 7 gauges we published today across 1929, using only what a careful reader could know at the time. And the board lights up like a switchboard. Of the 6 criteria that era can measure, September 1929 lights all 6. It remains the only perfect score in the whole record. The archetype. Valuation. Stocks at nearly 33 times their 10-year earnings, the 99th percentile of everything seen to that date. The curve. Short-term money forced above long-term bonds for more than a year, deeply inverted. Leverage. Brokers' loans nearly doubled in 2 years, to $1 of every 10 on the entire exchange. Breadth. The average stock peaked in May, 4 months before the index, a shrinking minority of names carrying the tape. Froth. Those 265 trust flotations. Acceleration. The vertical line you just saw. And positioning we mark honestly. No data existed in 1929, though a record call loan book says everything about how hard the crowd was leaning. But watch the clocks, because this is the lesson the whole system is built on. Valuation lit years before the top. The curve inverted 12 to 18 months out. Breadth broke 4 months out. The gauges are not a starting pistol. They are a regime marker. They tell you what neighborhood you are standing in, never the day the building comes down. That is why our board deals in tiers, not timing. The break, when it came in days, not months. Thursday, October the 24th. The ticker ran hours behind the selling, so nobody in this crowd knew what they were worth. Tuesday, October the 29th. 16 million shares changed hands, a volume record that would stand for almost 40 years. This photograph is Wall Street that week, the crowd outside the exchange, waiting for numbers that only got worse. And then the part nobody had priced. It kept going. Not for weeks, for 34 months. 381 to 41, minus 89%. There were violent rallies on the way down. The spring of 1930 recovered nearly half the crash, and every one of them failed. The trusts that had borrowed to buy each other went first. The flagship fund of the era's smartest firm eventually lost 99 cents of every dollar put into it. One sentence survives that autumn better than any chart. 9 days before Black Thursday, the most famous economist in America looked at this exact board, every lamp we just lit burning in plain sight, and declared that stock prices had reached a permanently high plateau. Irving Fisher was brilliant, honest, and ruined. The lesson is not that he was a fool. The lesson is that a story can stare at a lit board and call it a plateau. Instruments don't tell stories. What followed reached far beyond the exchange. 9,000 banks failed, and a quarter of the country stood out of work. That is why this episode is the rule book. Every criterion on our board earned its place in this one story. And it is why the board stays honest about what it cannot do. It named the neighborhood perfectly. It never named the day. Which brings us to this morning, 1929's board against today's live. As of this recording, valuation sits in the low 40s on the Cape, higher than 1929 itself, second in the record only to 2000. Margin debt has made 8 consecutive record months, the modern echo of those brokers' loans. And the curve, deeply inverted through 1929, is not inverted today. Some needles rhyme with that September. Some genuinely don't. Reading that difference, lamp by lamp, with every miss published, that is the whole point of instruments over stories. The board is live at agenticsovereigncapital.com/bubblewatch. Every lamp inspectable, every false alarm published. This episode is education, not investment advice, and nothing in it is a recommendation. History doesn't repeat, but it keeps a ledger. We'll read you another page of it soon.